Hello everyone, I am Dr. Rajesh Kumar Srivastava, Assistant Professor in BBD University, Lucknow. I am going to present my presentation on the topic Banking Sector Reforms in India. First of all, we will define the meaning of banking sector reforms in India. Actually, banking sector reforms in India refer to the initiatives and measures taken by the central government and the RBI to strengthen and improve the functioning of banking industry in the country. Now we will describe the objectives of banking sector reforms in India. These reforms aim to enhance transparency, efficiency, stability of the banking sector, promote financial inclusion, and ensure the availability of adequate credit for economic growth. Banking sector reforms in India include the following major points. First point is liberalization. The reforms began in 1990s with the liberalization of the Indian economy. This involved reducing government control, allowing private sector and foreign banks to enter the banking sector, and promoting. Second point is capital adequacy. These norms mandate the banks to maintain a minimum level of capital to absorb potential losses and ensure financial stability. Third point is asset quality. The main purpose of banking reforms were to minimize the non-performing assets, that is NPAs or bad loans. The Insolvency and Bankruptcy Code IBC was introduced to improve recovery mechanism. Fourth point is governance and risk management. The reforms focus to ensure transparency, accountability, and effective risk management to strengthen customers' protection. Fifth point is financial inclusion. The motive behind financial inclusion is to provide access banking services to unbanked sections of the society. For this purpose, Pradhan Mantri Jan Dhan Yojana PMJDY was launched. The use of technologies such as mobile banking and digital payments has been promoted to ensure financial assets. Sixth point is regulatory framework. The Reserve Bank of India plays an important role in implementing banking sector reforms. It has introduced various regulations and guidelines to strengthen prudential norms, risk management, and supervision of banks. Seventh point is merger and consolidation. To create stronger and more efficient banks, the government has encouraged merger and consolidation of public sector banks. This aims to provide operational efficiency, reduce cost, and enhance the ability to meet capital requirements. Eighth point is financial technology or fintech and innovation. The banking sector reforms also promote adoption of financial technology and digital innovation. This includes the development of payment systems. Now we will discuss the banking sector reforms since 1991. Actually, reforms, major reforms took place after 1991. The banking sector reforms in India after 1991 was focused to, first point, to liberalize and modernize the banking system, enhance efficiency. Second point, to promote financial stability. Under this point, several committees were formed to recommend measures and suggest reforms. So we will discuss some major committees and their recommendations. First such committee was Narsimham Committee. Former Finance Minister Dr. Manmohan Singh established the Narsimham Committee on 14th August 1991 to examine the functioning of banks. Committee was headed by Mr. M. Narsimham, the former RBI governor. The major suggestions of these committees were: first, to strengthen the banking system, including reducing government interference, increasing the role of RBI in supervising banks, and enhancing transparency. His second recommendation was reduction of statutory liquidity ratio (SLR) and cash reserves ratio to improve their liquidity positions, because these ratios enables bank to keep certain amounts of their deposits with them and with RBI. So the committee recommended to reduce SLR as well as CRR. His third suggestion was recapitalization of weak banks, the strengthening banks management, and introduction of prudential norms. Another committee was set up as Rajesh Khan Committee. Mr. Rajesh Khan was the former Deputy Governor of the RBI. This committee examined financial systems effectiveness for small sector